Good morning, good afternoon, good evening. Let's start with the next topic for the property chapter, that is basis of property. In basis of property, first we have to identify what is the cost basis, right? When we are selling the property, we need to reduce the cost basis from the selling price. So what do you mean by cost basis? Whatever we have paid in cash while acquiring the property plus debt obligation, if any, on that particular property, plus any other property or services which is received while acquiring the property. That is our cost basis, right? We should also include in this cost basis four more things, that is the commission, if any, paid while purchasing the property, right? This commission to the agent if he is dealing with the property transaction. So commission which is paid, any sales tax paid, freight or installation and testing charges, right? Legal and accounting fees if any paid, and excise tax, revenue stamp, recording fees, real estate taxes if any, the paid by the seller's liability, if it's assumed as a seller's liability. Okay. Next is adjustments. What all things we will adjust to receive a adjusted basis of the property. See, cost basis is the initial price, which whatever we are paying to get the property is the cost basis. So we will adjust few things to get the adjusted basis of the property. What two things we are going to adjust? First is improvement to the property. If there is any addition or improvement to a particular property, that thing we are going to adjust. Second is if there is a depreciation, right? It's a depreciable asset. If it's a building or any other asset which is depreciable, then we will reduce the depreciation. So these are the adjustment which will be done in the cost basis which we calculated right now. So improvements will be added and the depreciation will be reduced. This is how we will receive a adjusted basis. Okay. Now let's see about the real properties cost basis. What will be included and what will be excluded. Okay, so if I talk about real property means what? Just the real estates, right? The building, land, all those are called real property. All the real estates are called real property. What all things will be included in it? First is settlement fees and closing stock. So you know what happens over there in US, they have some settlement fees and they have some closing stock that they need to pay while purchasing the property, right? So settlement fees, closing stock will be a part of your cost, right? Abstract fees, charges for installing the utility services. Okay, if you need to pay some extra charges to get some things done or improvements done while purchasing the property, or some installation which is necessary, right? So that will be included. Legal fees such as like title search, contract, deed, whatever you pay for these things will be included as a legal fees in your cost. Recording fees, survey fees, transfer fees, owner's title insurance, any amount the buyer agrees to pay to the seller. Okay, so this all things will be included in our cost. What will be excluded? What all things we are not going to take, we are not going to adjust in our cost basis, that is casualty insurance premium. Okay, if you have paid a premium, right, for your building, and that is a casualty insurance premium, casualty theft kind of insurance premium, fire insurance premium, right, that all premiums will not be included in your cost basis. Then there's a rent for occupancy and before closing. Before closing means what? Before you are purchasing the asset, there is some rent which is pending, right? That will not be included in your real property cost basis. Next is utility charges before closing. Before closing means simply one, remember this thing, before purchasing the asset, whatever was the charges paid, right, or whatever are the expenses incurred by the seller, the buyer is not going to incur it, included in the cost, right? Then the points, mortgage insurance premium, loan assumption fees, cost of credit report, and fees for appraisal. So this all are related to finance. If you have financed your property, right, what do you mean by points now? Points is some type of discount which we get, right, while acquiring the land or building. If we are taking it on mortgage, and if the financial institution has agreed to provide you the finance at a particular amount, right, then whatever is the premium which will be paid minus all the finance which is charged by the, which is provided by the financial institution, will be the points. It is basically the discount, I can say. Okay, so points, mortgage insurance premium, whatever insurance premium you are providing, you are paying, that will not be included. Loan assumption fees, while taking the loan there is some processing fees and everything, cost of credit report, everything, that will not be included, that will not be a part of your cost. Then there's a refinancing fees, that will also not be considered in the cost. Amount in escrow for future payment of taxes and insurance. If you put certain amount in escrow, right, which is used for paying the further real estate taxes, whatever building and land you have purchased, that for that land and building you'll have to pay some taxes to the government. So you are, what you are doing, you are putting certain amount aside in an escrow account, so that will not be included in your cost. Just simply remember, whatever benefits we are getting right now that are directly connected to the building will be included, but just one thing, two, three things will be excluded. First is insurance premium. Never include any kind of insurance premium in your cost basis, right? Next is your abstract fees for loan, like whatever is your mortgage points, right, the payment which you are doing to get the finance from the financial institutions. Okay, and third thing, if you have set aside some particular amount in the escrow which will be used in future, right, for paying the taxes and insurance, that will not be included over here. Only remember this thing, it is important, because in question they will give you a lot of line items, right, the amounts and the line items they will give. You have to make sure out of those what all things will be included in your cost basis, and based on that the calculation will be done. Okay, next is basis of property if acquires a trade or business for a lump sum consideration, right? When you are acquiring a different totally a whole business, then in that you will divide the amount into three parts. First, whatever cash and general deposit you are receiving, just allocate it to the cash. Then whatever asset you are receiving, right, take the fair market value of the land and building. So whatever, say for example you have received 1 lakh, out of this 1 lakh, 10,000 is directly mentioned in your balance sheet as a cash. So allocate the 10,000 as a cash. Then what you will do, whatever is your asset in the balance sheet, that is land and building, right? So land, building, take the FMV, right? Based on the FMV, the asset will be divided. Okay, based on the FMV, the proportionate amount will be allocated. Remaining, whatever is remaining will be your goodwill. This is simple acquisition of any other business. Just take whatever cash and general deposit you have received as it is, and then what you will do, you will just take the FMV of land and building, because see, the whole lump sum amount will be given, right? Now you have to allocate it between the land and building. What you will do, you will take the FMV of the land, FMV of the building, and distribute that amount between those two FMV ratios. Whatever is the remaining will be your goodwill. Okay, next is adjusted basis. We have just seen that we will do some increase and some decrease in the cost basis. This is how we come to the adjusted basis. So let's see what are the increments which we are going to do in the cost of our asset. Increase the if there is any capital improvement. If there is any capital improvement, amount incurred. What do you mean by capital improvement? If any amount is incurred or paid to demolish the structure, right, then also that demolishing cost you will add to the basis of land on which the structure was located, right? There are some temporary structures. If that structure is demolished, right, there is a cost incurred to demolish that. That cost will be included in the cost of land on which that structure is located. Okay, next is assessment for local improvement. This should not be a part of your adjusted basis. Do not deduct them as a sorry, this should not be deducted as a tax, but this should be a part of your cost basis. Okay. There are some improvements, local improvements, like for example, if you have a building, right, but the area just beside the building is not proper, so you invested some money to improve that area, like sidewalks, we can say, roads, if you are improving, the water connection, utility extended, if you're like improving the electricity utility and everything, which benefits the building, right? So that cost should not be expensed off. That is not your taxes. That improvements that are called as local improvements will be a part of your adjusted basis. Okay, it will form a part of your adjusted basis. Increase the basis by any amount of improvement, repair that restores the property. So this is very simple. Whatever improves the quality of the property, right? If there is any repair or improvement which is major, it should be added to the cost basis, right? What we are going to reduce from the cost basis, first is depreciation, that we all know. Second is non-taxable corporate distribution. When you do the corporation chapter, there you will learn that whenever there is a distribution of the property, right, by the corporation to their shareholders or by the partnership firm to the partners, then up to that amount, whatever has been distributed, right, that is at that time not taxable. So that's why it should be reduced from the basis. See, there it is not taxable, so it should be reduced from the basis. Second is insurance proceeds or other reimbursement and deductible loss not covered by insurance. If there is a loss, right, on your building, land and building, if you have incurred a certain loss and you are receiving the reimbursement or some insurance proceeds, you are going to reduce it, right? And any deductible losses that are not covered by insurance. Apart from that, if there is any extra losses which is not covered by insurance, that you're going to reduce it. Next is depreciation and 179 section plus bonus depreciation. If your asset is eligible for 179 and bonus, in previous session we saw about 179 deduction and the bonus depreciation, right? So this all things should be reduced from the cost basis to get the adjusted basis. Then there's the easement or grant which is given by the government, right? The government, or if you receive any easements or any benefits, right, you should reduce it. Then there's the credits claimed. For example, in vehicle, we claim a alternate fuel vehicle credit, motor vehicle credit, residential energy credit. Okay, for example, if you have bought any solar panels or some energy saving equipments for your house or maybe for business, then you get a credits for that. Okay, so those credit, if taken, should be reduced from the cost to get the adjusted basis of the cost of the property. Got it? Adjusted basis is simple. What all things you need to add, just remember, and what all things you need to reduce, just remember those things. Next is property received for service. Now, if you are receiving a property for providing a services, then what will be it? The whatever is the FMV of that property which you are receiving, you will include that amount as income for providing the services, right? And that FMV will only be considered as a basis of the property. So FMV minus price paid, if like while taking the property, you have provided services and also you have provided some particular amounts, right? So FMV minus price paid will be considered as income, and whatever you have included in income, that part will be called as your basis of property. Got it? Next is bargain purchase. What do you mean by bargain purchase? Means if you have got the property for a lesser amount, right? For example, FMV is 1 lakh, right? And you are receiving the property and paying just 50,000, right? So it is a bargain purchase, receiving the property at a lesser amount. So whatever is the FMV, you will just reduce the purchase price, whatever you are paying, that will be the income. And your FMV, in this case, if it's a bargain purchase, your FMV will itself be the basis of the property. You are not going to reduce the purchase price. The FMV itself will be considered as the basis of the property when you include it in your books. Okay, this was about bargain purchase. Next is involuntary conversions, condemnation, we can say. Means what? If a government, right, if the government takes your property mandatorily just for redevelopment or improving the infrastructure facilities, like just uh, increasing the area of airport area, or wherever there is a requirement, they can condemn your property, means they can acquire your property mandatory. In that case, what happens? This is the one example of government. Second is, if there is any other situation like this, mandatory acquisition, I can say. Okay, in that case, what will happen? If a similar or related party is there, right? Then what you will see, what you will do is, if you're receiving a building and if you're giving a building, right? So new building is equals to old building. You're receiving a new building against an old building. So what will be the basis of the old building? Because you'll have to calculate the gain, right, while giving up that property. So old building basis, you will take whatever was there in your hands, you will take the old building's basis. You will add any loss, you will add any gain or reduce any loss. You will add money received, money used in same property, and you will reduce money not used in same property. Means what? Let's understand it by the next chart over here. For example, there is a net book value given, right? And for that property, if government is paying you certain amount, let's say your net book value in your books, net book value means cost minus depreciation, whatever is your book value. Okay, so let's say it's 1 lakh. Okay, and government is paying you for this property 1,50,000. So I can say your total gain is 50,000. Okay, now the FMV of the property purchased by taxpayer. So see what government did. Government took your property and gave you 1,50,000. Now what you did, using this 1,50,000, you have purchased another property. So new property which you are buying is having a FMV of 1,20,000. So I can say my total gain is 1,50,000, but out of this 1,50,000, 120 I have used. See, out of 150, 120 I have used to buy the similar property, to buy the another property. So I can defer the gain of 20,000. I can defer the gain of 1 lakh and 1,20,000, right? Between the difference between 1,20,000 and 1 lakh, I can defer it. Like I can recognize later on. But whatever is the amount which I have not used, which was given by government. Government gave me 1,50,000, but I have taken the similar property just for 120. So I can say 30,000 went into my pocket. So 30,000 is my gain, which I'll recognize right away. Recognize now only. Got it? So this type of sum will come in exam. Just make sure to draw this chart, right? First take the net book value of whatever property you are having, and then reduce whatever was paid by the government. So that is your total gain. Out of this total gain, you have to figure out how much will be deferred and how much will be recognized. How much you will defer? Whatever is the net book value minus similar property, whatever you have purchased, that price you will take the difference. That amount you will defer, and the difference between the FMV, like whatever you have purchased, whatever government has given you. See, if instead of this 120, if it would have been 1,60,000, then nothing to be recognized in the book, right? Nothing should be recognized because government has given you 1,50,000, you have utilized whole 1,50,000. All right. Next is basis will be the FMV of the new property. Now see, what will be the basis of this new property which you are acquiring? This new property which you are acquiring, what will be the basis of it? Whatever is the FMV, means here in our case it was 1,20,000, right? Out of this you will reduce the deferred gain. Whatever deferred, here we are deferring 20,000. So ultimately my basis will be 1 lakh. Got it, guys? These two questions will be asked in the exam. There will be for sure one question from this topic. So don't forget to solve MCQs on this topic. Whatever is your net book value, right? Just compare it with whatever amount you're receiving from the government or whatever, like other party, whatever you're receiving the amount. This is your total gain. Out of the total gain, you'll have to decide how much you are going to defer and how much will be recognized in your books. For deferring, you will have to compare your net book value with your FMV. Whatever is the difference, you will defer it, right? You will defer it. And FMV minus whatever is government paying to you is the amount which is the gain which you are going to recognize in your books. Now, you will also be asked in the exam that what is the basis of the new property which you are receiving. So, the basis of the new property is simple. Whatever FMV is given, you will take it, and the gain which we are deferring in this transaction will be reduced from the basis. So, this is how FMV of the new property minus deferred gain. Alright. Next is inherited property. If you receive a property in inheritance, or if there is a death and at that time you are receiving the property. So, what you will do, you will take FMV on the date of death or alternate valuation date. See if there is a death, okay, take the date of death, add 6 months to it. This is your alternate valuation date. Okay, either you can take the FMV on the date of death or FMV on the alternate valuation date. Simple. Okay, if there is a step up means what? Whatever is your cost basis, the FMV of that property is higher than the cost basis, right? When FMV is higher than the descendants basis, so gain will always be a long term. Whatever is the gain will be long term. In the books of the person who is dying, right, and all his assets are getting transferred to some other like their beneficiaries or the people whom he has listed in the will, right? For them, the person who are receiving the property will recognize the property in their books at what amount, that is FMV on the date of death or maybe alternate valuation date. Alternate valuation date is nothing but death date plus 6 months. Okay, and if the FMV is higher than the descendants basis, then what descendant will do, in descendants tax return, it will be counted as a long term gain in descendants tax return. Okay, next is property charged, like if property has been changed from personal use to business or the rental use. Right now, if I am using the property for personal use, now I have changed the property for using it in the business, or I am renting out the property. What I'll do, I'll have to consider two things. At what amount I will depreciate the property. Second, what will be the basis when the property is sold, right? When the property is sold, at that time I'll have to reduce the cost price. So what will be the basis I'll take while selling that property? Let's see. If I talk about the depreciation, what is the basis for depreciation? It will be FMV on the date of change or adjusted basis of property on the change, whichever is available to us, right? Or out of this, whichever is lower, we will take. Okay. So FMV on the date of change or adjusted basis of the property on the change, whichever is lower, we are going to take as a basis for calculating the depreciation. See here, I think it is mentioned. FMV or adjusted basis, whichever is lower, will be taken for calculating the depreciation. Right? Next is, what will be the basis when we are selling that property? Okay, what will be the basis? Just take the adjusted basis of the property. Okay, whatever is your property, take the adjusted basis if it is sold at gain. Or else take the FMV on the date of conversion if it is sold at loss. How you will do this? See, this is a tricky language which has been used, or people usually get confused in this, that if there is a sales of property, then how we are going to see, like how we are going to take the adjusted basis. For that, just remember this chart. Take the FMV on the conversion date and then list your adjusted basis. Okay, if you have sold, right, if your selling price is more than adjusted basis, right, if your selling price is more than your adjusted basis, then your basis will be this amount, adjusted basis. Okay, next is, if your selling price is less than adjusted basis, means within the adjusted basis, if it is, the basis will be the FMV. Take the left hand side figure. Just remember this thing. Draw this chart Okay, list down your FMV, list down your adjusted basis. If your selling price falls above adjusted basis, take the left hand figure, that is your adjusted basis. If your FMV is above, like if your selling price is above the FMV and below the adjusted basis, then your then your basis for calculating the gain will be your FMV. Okay, let's take one example. For example, let's say your FMV on the conversion date. When the date when you are converting, the FMV is say 1 lakh and your adjusted basis is 1 lakh 20. Now this property you are using, and let's say you're selling it after 3 years. So after 3 years, you are selling it at say 1 lakh 50. So where it will fall? It will fall above adjusted basis, right? If you're selling it at 1 lakh 50, then in that case selling price will be 150 minus cost which you are going to take to calculate the gain will be 1 lakh 20, and 30,000 you will recognize as a gain. Now let's say if your selling price is just 1 lakh 10, okay, it's above FMV but less than the adjusted basis. So what you will do, you will take FMV as your cost. So your selling price is 1 lakh 10 minus your cost will be 1 lakh, right? So 10,000 will be your gain. This is how you are going to calculate, all right? Next is securities. Now, in case of securities, there are two options. We have already done this in corporation chapter. So just go through that topic. Securities, if it's a non-taxable stock dividend or a stock split, right? Then we are just going to reduce the basis of existing share by the amount of basis allocated to the new share. Okay, if you are already having existing securities and stock against which you are receiving a stock dividend, which is a non-taxable stock dividend. So since it is non-taxable, we are going to reduce it from the basis of the original stock which we are having on hand. Okay, got it, guys? Next is return on capital. Whatever, if it's a return on capital, if it's not a stock dividend, if it's you're reducing the capital, then it will also reduce the basis. Security can be having a two effects. It can have a two effects, right? If it is a non-taxable stock dividend or a stock split, reduce the basis of existing share by the amount of basis allocated to new share. Let's say, for example, I am currently having 100 shares into $10. So the cost is 1000. Now I am receiving a stock split for say $50 or 50 shares. I am receiving 50 shares as a non-taxable stock dividend. Okay, so total how much I am having? I am having 150 and total cost is 1000. Right, so what I'll do 1000 divided by 150, whatever is the amount, 1000 divided by 150, this will be allocated to the cost of this 50 shares, right? This is what we do in a stock split. We are not going to adjust the whole basis, but we are going to adjust the per share cost according to the basis which is already there. Okay, next is return on capital. If it's a return on capital, we will reduce the basis. Let's move on to the next and important topic. Till now we have just done all the basic things, that how the cost will be calculated, in what scenarios the cost calculation will come into effect, how the adjusted basis will be calculated, what all things will be included and excluded from the cost. Okay, next topic is the like kind exchange. From this topic, almost the whole business property chapter is held on this topic only. Okay, so let's start. If you are transferring a property and that is mandatory, that should be a real estate. Okay, if it's a real estate property, means land and building, right? For other business property, if you're transferring a property and receiving a property, and that should be a business property. Okay, the taxpayer will not pay any tax at the time of exchange, but the taxpayer will pay tax when the new property is disposed of, right? For example, if you are transferring a building, for let's say a building is getting transferred, right? And you are receiving a new building. So while this transaction is happening, you are not going to recognize any gain. When this new building is disposed of, at that time you are going to recognize the gain. So let's see how the calculation will be done. Remember one thing, this like kind exchange will not applicable if the property is tangible personal property, means anything other than real estate, this like provisions will not apply. Whatever now we are going to understand, this will not apply to tangible personal property. So what transactions involve this business, trade or business? See, if you are transferring a land, right? Land improved with apartment house. A land is there and also it is attached with apartment house. Against, if you're giving that and you are receiving a business property, right? A land which is improved by store building. Okay, or else you are giving a city property and receiving a farm property. You are receiving unimproved property and you are giving a improved property. Okay, you are giving a residential house, right? Real property, residential house, and you are receiving a vacant land. You are just giving a building, a residential house or apartment, and you are receiving just a land, plot, vacant land. That's it. Real estate owned by a taxpayer is given up, and real estate for lease. See, if you have owned a real estate, you have sold that real estate and you have taken the other property on lease, or maybe same property on the lease for more than 30 years, then this all transactions will fall under the provision of like kind exchange. Okay, now replacement property means what? This all are called replacement property, right? If you're replacing the property, giving one property and taking up the other business property, then this, in this case, there will be one MCQ from this topic, replacement property. It should be identified within 45 days. Like what we are given up, what we are taking, that should be identified within 45 days. And whatever property, right? Whatever property you are getting, it should be received within 180 days after the date on which the property is given up in exchange of transfer or due date of tax return, whichever is earlier. The property which you are going to receive should be received within 180 days. See, you have given up the property, but you have not yet received the property. You still have 180 days to receive the property from the date of exchange, the date of the transfer which is taking place. From that date, take 180 days or the due date of tax return, right? Whichever is earlier, till that date you will have to receive the property. Else, the provision of this like kind exchange will not apply. Replacement property should be identified, means what property you are going to deal, it should be identified within 45 days. And then once it is identified, once the transaction has happened, once you have given up the property, you should receive the other property within 180 days. Okay, so let's see how the gain will be recognized. Transaction only for like kind exchange, receiving and giving up. So it's just a like kind exchange, means similar property if you are giving up and similar property if you are receiving. So how you will do? Whatever is your amount realized, plus take first take that, okay, money, whatever money you have realized, plus FMV of the property or services which you are receiving. See, whatever benefit you are receiving, whatever benefits you are receiving, if you have received a money, take it. Whatever, right now what we are calculating, whatever amount you are realizing, okay, take the money which you are receiving along with the property, take the FMV of the property which you are receiving, plus whatever you are giving up. If along with that property there is any debt or obligation, right, attached to that property, that also you will add it. Why? Because it is the benefit for me, right? The seller, it's a benefit, but it is assumed by the buyer. So now, till now the mortgage was paid by me, now it is going to be paid by the seller, the buyer, I can say, right? So that benefit also I'll add, minus any exchange expense if I have paid. Okay, if I have paid any exchange expense, then I'll reduce it. This is the amount which I have realized in total in the exchange transaction, I can say. Okay, Second thing we need to calculate is the adjusted basis of property. What do you mean by adjusted basis? Simply the cost minus depreciation. Okay, this is our adjusted basis. Now we have got amount realized, we have got adjusted basis. So what you will do, you will take the difference. You will take the difference, and this is the figure of gain. But out of this gain, how much should be recognized? Because earlier only I said that this type of transactions are non-taxable, right? These transactions are not taxable at the moment when the transaction is happening. But later on, this type of transactions, right, will be taxable. So at this moment, only if it's a like kind exchange, only if you're receiving property and giving property, only this thing is there, then it's not taxable. But if you're giving up property, if you're receiving another property, plus you're receiving money, plus there is a debt involved, then particular amount should be recognized. So how much amount of gain will be recognized? We will see over here. First, what is the gain amount? Gain is nothing but amount realized minus adjusted basis, that is this, plus any liability assumed by the taxpayer. See, it can be vice versa case. Let me tell you like this. Wait. If a taxpayer is there, and for example, there are two people, people A, person B. Okay. If a person A is providing the property, right, building for example, and it's having 1 lakh of cost plus 20,000 of mortgage is attached. B is transferring the property which is having 1 lakh plus I can say 30,000 is the mortgage on that, plus B is also providing a money of 20,000. So I can say A is receiving total 1 lakh 50 and not 1 lakh 50, A is receiving total 1 lakh plus 20,000 is the cash. So plus 20,000 plus whatever mortgage was paid by A is now paid by B. So plus 20k he's receiving a benefit of 1 lakh 40k he is receiving. Okay. Now I'll reduce whatever I have given up. So what I have given up, the property is having a value of 1 lakh. Second, what I have given up, I have assumed the liability of the other person. I have assumed the liability of the other person, right? So that also I can say it's a payment for me, future liabilities. So out of 140, 130 I'll reduce as a cost. So my benefit is just 10,000. Don't worry, we are going to do these examples right now. I have included a lot of examples for this topic because it is important, and without looking at the examples, you will not be able to understand it. Okay. So, okay, how much you are going to recognize? So, first step is to calculate the gain. What is the gain? Amount realized minus adjusted basis of the property. What is amount realized? Whatever you are receiving and whatever benefit you are receiving, means mortgage was paid by the buyer till date, it is getting transferred by the seller by date, and it is getting transferred to the buyer, right? So money plus FMV plus debt which is getting transferred minus exchange expense. So that is amount realized. Out of this amount realized, you will reduce the adjusted basis of the property, right? And also if any mortgage is assumed by the buyer, assumed while taking the property. So this two things will be reduced from your amount realized. That will be your gain amount. Now, how much you are going to recognize? Amount of bought received or amount of gain realized, whichever is lower. What do you mean by bought received? Bought received is called as apart from property, whatever you are receiving is your bought. Just remember this thing. Apart from property, whatever you are receiving is a bought. If there is a loss, then it should not be recognized or you will not get any deduction, right? Let's take one example. Bought means what? Money received plus FMV of other property received plus net liability assumed by other party. Okay. Liability minus liability of taxpayer minus cash paid. You can see like this. Liability minus liability of the taxpayer minus cash paid. Let's take one example. It will be more clear. Okay. Let's say you are transferring, right? Person A is transferring a property which is having a cost of 50,000. Okay, and against this 50,000, he is going to receive a real estate which is having a cost of 60,000. Cash also is going to receive, that is 20,000, and some other property is going to receive, that is 10,000. So see, against this property, some other properties received, this is non-taxable. But apart from this, whatever you are receiving means cash and some other unlike property, not a similar property, then this will be called as your bought amount. Okay, first step is to calculate the gain. What is the gain? Whatever you are receiving, what you are receiving, 60,000 plus you are receiving cash plus you are receiving unlike property. So it is 90k. This is I am receiving. This is amount realized. I'll reduce the adjusted basis, that is 50,000. So what is my gain? It's 40,000. Can I recognize the whole 40,000? No, I'll just recognize up to the amount of bought received. What is the bought received? 20 and 10, that is 30,000. I'll recognize 30,000 and remaining 10,000 will be not recognized, means it will not be taxable. Okay, next is gain or loss on the unlike property. Now see, you are receiving this unlike property. Someday it might happen you are going to dispose of that property, right? Or if you're going to sell that property, at that time, how you will recognize the gain or loss? You will take the FMV of that property minus adjusted basis of that property. This is how you will recognize the unlike properties gain or loss in your books. Let's take a huge example. This will help you to clear out your concept. I think I have included one more example. Yeah, stepwise example is there. So this will be the easier to remember if you remember this in the stepwise manner. Okay, let's take first this example, then we'll look at there, because here I have included in a stepwise manner. It's easy to remember. Let's say, for example, person A is there and person B is there. Okay, now person A is giving up some properties and going to receive some properties. What all properties he is going to give up is having a adjusted basis of say 8,000. A person is also going to receive from from B 1,000 of cash. Okay, exchange expense is paid by A is of $500. See, I am going very slow because this concept is very important. Okay, mortgage attached to this property is 3,000. So I can say for A, 3,000 will also be considered as a benefit because there was a mortgage attached to the to the property which is given up. So till now, A was paying the debts. Each month he was paying the premiums or the installments for that mortgage. Now the whole mortgage is getting transferred to B. So from now, the mortgage insurance, mortgage premiums will be paid by B instead of A. So for A, it's a benefit, right? 3,000. 8,000 is the cost of asset given up. He is going to receive a cash of 1,000 and exchange expense which is incurred by him is $500. Now what B is receiving? B is receiving the property which is having FMV of 14,000 and a mortgage attached to this property is 4,000. Okay, so let's see step 1. First we will identify the realized gain. Step 1 is realized gain. What do you mean by realized gain? Whatever we are receiving minus whatever we are giving up. Okay, we'll take that. So in our example, what we have received is the property which is having FMV of 14,000. So we'll take the FMV. See, whatever you're receiving, take the FMV of that thing. If in question it's given FMV and the adjusted basis, take the FMV of whatever you're receiving. So FMV of asset received plus you will take cash received, right? 14,000 plus if you have received some other thing, what you have received is cash. A is receiving cash. All right, so 14,000 plus cash plus what other benefit has A received? A has received the benefit of mortgage given up. He has given up the mortgage, so it's a benefit for A. So we are going to add that also. So what I can say, my total realized amount is 18,000. But out of this, what all things have I given up? I have given up the property which was having adjusted basis of 8,000, right? So I'll reduce 8,000. I have incurred the exchange expense of 500. So I'll reduce 500. I have acquired the mortgage of the property which is getting transferred to me. So for me, it's a cost, right? Now, till today, the seller was paying the mortgage of 4,000. Now, from the date of exchange, it is getting transferred to me. So that is a cost for me, right? So 4,000 I'll reduce. Simply remember one rule: whatever you are giving up plus whatever the things the cost you are assuming will be reduced, right, from the whole realized amount. So this is your realized gain. After adding and reducing all things, you will receive a realized gain. Okay. Next is find the bought amount. Now out of this, what is the bought amount? Apart from property, whatever you are receiving will be your bought. So apart from property, what you are receiving is cash. So I'll just add the cash plus FMV of other property. Am I receiving any other property? Against this one property, I'm receiving only one property. So I'm not receiving any other property. So it will be 0. Plus net liability. See, I have given up 3,000 and I have taken 4,000. So if 3,000 minus 4,000, liability given up, I can say liability given up minus liability assumed. If this is a positive figure, then it will be considered as a bought amount. It's a benefit, I can say, right? So here 3,000 minus 4,000 is a negative. That's why we are not going to include it over here. So my net bought received is what? Just $1,000, which is the cash received in our example. I'll reduce the exchange expense from this bought received. Exchange expense was $500 in our case. So I can say my total amount of bought is just $500 because out of the 1,000, the cash which I am receiving, I am incurring the expense of 500. So I'll reduce that 500 amount. Third step is how much we are going to recognize. See, now we have got this amount, right? 5,500 was our realized gain. Out of this, how much we are going to recognize up to the amount of bought received or realized gain, whichever is lower. In our case, what is the amount of bought received? We have just now calculated is step 2 is 500. So step 2 or step 1, whichever is lower, you will take 500 minus 5,500. So it will be 500, which you are going to recognize as a gain out of the realized amount. In question, they can ask, they can twist the words. They will ask you what is the realized gain. Then you have to calculate just step 1. They can ask what is the bought amount. Then you'll have to calculate step 2. They can ask what is the recognized gain, right? Or they can ask both. What is the realized and what is the recognized? This is how you are going to calculate. First and foremost thing which you'll have to remember, whenever you see this type of sum, just draw the charts like this. Whatever you are giving up, whatever you are receiving, and just draw the steps. Step 1 is this. Step 2 is find the bought amount. Step 3, out of the bought, step 2 and step 1, what you are going to recognize. Then whatever property you are receiving, what will be the basis of that property which you are going to include in your books. There is one calculation which you will have to remember, and this is most important. Okay, so see, whatever basis of property is there which you have transferred. In our case, what was the property which you have transferred? It was the property which is having basis of 8,000, right? So you will take 8,000 as an initial amount. Then what you will do? You will add the net liability. Here, whatever liability, in short, what's happening? See, adjusted basis of property given up. Okay. You will add, what you will add? Liability assumed. Liability assumed is what? 4,000. Minus liability given up, right? It's a benefit for you. So liability assumed you will add minus liability given up. So it's a net amount we are going to add, or maybe it can be reduced. If the liability given up is higher, then it might be reduced. Okay. Then there is a exchange expense which will be added, which is step 2, and bought received. Okay. Minus bought received. Bought received, you will reduce it. Whatever benefit you are receiving, you will adjust it in the basis of the property. So minus bought received. So what I can say that these two are nothing but step 2, right? $500 ultimately we are going to reduce. The bought received we are going to reduce. So I can say whatever is the basis of the property transferred, I'll take the net liability, I'll add the net liability. I can say whatever liability is given up, right, minus whatever liability I'm taking, assuming whatever liability is assumed by me, I'll add it up in the basis. I'll reduce the liability which is given up from the basis. Okay. And then third thing which you are going to calculate in this table is we will reduce the bought received amount. Remember, reduce the bought received amount. Then we'll take step number 3, which was gain recognized. If it's a gain recognized, we will add it. If it's a loss, we will reduce it. Okay. Any cash paid, if you have paid any cash, right? It can be a vice versa case. In our case, we are receiving the cash. If you have paid any cash, then you will add it. Got it, guys? This is most important topic. I'll just explain quickly in a very brief manner this topic again, okay, because this is important. Sorry, guys. Okay. See, what do you mean by like kind exchange? If you're giving up a property and if you're receiving a property, right, then this is called a like kind exchange and it is not taxable. Just the property exchange is not taxable. But along with the property, if you're transferring any mortgage and if you're transferring any cash, or if you are receiving a property, along with that property, if you're receiving a mortgage or if you're receiving a cash, then in that case, we will have to calculate the gain. To calculate gain, there are steps. First step is you'll have to identify the realized gain. What do you mean by realized gain? Whatever you are giving up, right, will be your cost. Whatever you are receiving will be your amount which you need to take into consideration. So whatever you are receiving, FMV, take the FMV of the asset. So take the FMV of the asset received. If you have received cash, take the cash. If you have received the benefit of the mortgage, means if you are giving up the mortgage, right, the mortgage is given up, so it's a benefit for you, add it in this calculation. You will reduce whatever things you have exchanged or given up. You have given up some other property, so take the adjusted basis of the property. Just remember a simple sales exchange transaction, right? Selling price minus cost we take. But here the selling price will not be there. We will take the FMV of the property which you are receiving, and whatever you are giving up, take the adjusted basis of that property. Okay, so FMV of the asset received plus cash received plus mortgage given up. This is your amount. You'll reduce whatever you have given up. What you have given up is adjusted basis of the property which you have given up. You will reduce exchange expenses, right? If you have paid the exchange expense, whatever is incurred from your pocket, you will reduce that. If there is a mortgage assumed by you, you are assuming the mortgage of the other property which you are receiving, right? So you will reduce that. So this will be your total realized gain. Out of this realized gain, how much should be recognized? It will depend on whether there is a bought amount or not. How you will calculate the bought amount? Whatever cash you are receiving plus net liability. Okay, whatever liability is given up minus liability assumed by you. See, just remember, bought means just the benefit which A is receiving over here. Okay, if A has assumed a liability of 4,000 and given up a liability of 3,000, then it's not a benefit, right? He is going to assume extra 1,000 liability, then it's not a benefit. But instead of B's case, if you see from the B's point of view, then how it will be considered? B is giving up 4,000 of mortgage, but he is assuming the liability of only 3,000. So for him, 1,000 will be the bought amount that we will include over here from the point of view of B. Okay, then you'll reduce the exchange expense. That is your step 2, that is your bought amount. So how much you will recognize? Step 2 and step 1, whichever is lower, you will recognize, that is $500. Basis of the property received. How you are going to calculate the basis of the property? Whatever amount of property, the adjusted basis of the property you have transferred, take that first. Then you will adjust the net liability, like add the liability assumed by the property, by the buyer, right? The liability which is attached to the property which I am receiving, I will add it to the basis of the property given up, and then I'll reduce the liability assumed by the seller. Okay, so that I can say net liability, I'll add or less depending on whether it's positive or negative figure. Okay, then exchange expense and bought received. So I can say that just take the step 2 and reduce it. Then just take the step 3. If it's a gain, then add it. If it's a loss, then reduce it. Then I'll add cash paid. If I have paid any cash amount, right, then I'll add it to the adjusted basis. So this is how we'll come to the adjusted basis of the property. Clear, guys? Now what you guys can do is, you guys can pause right now and solve this whole sum again from the point of view of A and from the point of view of B. This is how you'll be clear with this topic. Okay. Next is, we have one more example. Let's take, see here we have included from the point of view of Adam, and from the point of view of Charlie. Okay, so we have included from both point of view. For example, Adam is receiving a house, apartment house, who is having FMV of 2,20,000, adjusted basis of 1 lakh, and mortgage of 80,000 is attached to that property. Adam is giving up to the Charlie some other property, that is similar property, which is having FMV of 2,50,000, adjusted basis of 75, and mortgage of 1,50,000. Charlie, Adam is also going to receive Charlie's house, plus along with the house, Adam is going to receive a cash of 40,000. Okay, and Charlie is going to receive only Adam's house, and Charlie is going to pay the expense of the exchange expense of 10,000. All right, so how you are going to calculate? See, here we have done from the point of view of Adam and from the point of view of Charlie. For Adam, what you will take? FMV of the property received. What you are receiving, take the FMV of that property for Adam. Okay, wait. So here there's one confusion. These are the things which Adam is giving up. These are the things which Charlie is giving up. Okay, so Charlie is giving up the property which is having FMV. So what Adam is receiving? Adam is receiving these things. Okay, and so let's calculate it. Adam is receiving property which is having FMV of 2,50,000. So we will take the FMV of the property. We will add cash received. Adam is also receiving a cash which is 40,000. Plus buyer assumed liability. He is also receiving the mortgage. He is giving up the mortgage and also receiving. So whatever he is giving up will be the benefit. So I can say that I have taken the FMV of the property. Let's take some other color and understand it. See, Adam is receiving FMV of the property plus receiving cash plus he is giving up the mortgage. So this all three things will be added. This is your total amount which you have realized. Now out of this, realized what all things you are going to reduce, whatever is given up. So what all things is given up? Adam is giving up the property which is having a FMV 2,20,000, but it's having adjusted basis of 1 lakh. So while giving up, while reducing, we are not reducing the FMV, we are going to reduce the adjusted basis. This we will reduce, right? Minus mortgage which is assumed by Adam. 1,50,000 is assumed, right? Has Adam paid any expenses of exchange? No, it is paid by Charlie. So here we are not going to reduce, right? So you can see what all things we have added. FMV of the property, cash received, right, and buyer assumed liability. So Adam has given up the liability, right, to Charlie, which is 80,000. Next, what he is giving up? He is giving up the adjusted, the property will take the adjusted basis of the property. He is giving up the, he's taking the mortgage. So for him, it will be a reduction from the base, from the gain, I can say, right? He's assuming the liability that we are going to reduce, and this is how you will come to a figure that is your realized gain. Now you have to see out of this realized gain how much you will recognize. So for Adam, what is the bought received? Bought received is just 40,000, right? Also, we will see that whether the liability which he has assumed, right? Bought received is 40,000. So liability which he has assumed is 1,50,000, but he has given up the liability of 80. So I can say he has assumed a higher liability. So for him, there is no bought received for case of liabilities, right? So total bought is 40,000. So how much you will recognize, 40,000 or 1,20,000, whichever is lower. That comes to a figure that is 40,000. Now, how much did the Adam is going to recognize as a cost of new property? That you are going to calculate, guys. Okay, how much amount Adam is going to consider as a value of the property? Let's calculate it. Okay, for Charlie you are going to calculate. See, whatever is the adjusted basis of the property given up, that is, let's do it over here. You guys can also do it in your book. Okay, whatever is the adjusted basis of property given up, that is 1 lakh. Liability which is assumed by Adam, that is 1,50,000. Liability which is given up by Adam, that is 80,000. Then you will add step 2, right? Step 2 is it a positive amount? Step 2 is bought received, right? Bought received is 40,000. So you will add 40,000. You will add 40,000. Is there any gain? Did you recognize a gain in the step 3? Yes, gain recognized was 40,000. So what are we doing? Gain, if there is a gain, are we going to add it or are we going to reduce it? If it's a gain, we are going to add it, right? Gain which is recognized as step 3 will be added. Bought received will be reduced. Actually, whatever bought you have received will be reduced, right? Bought will be reduced. Gain will be added. All right. Did Adam paid any exchange expense? No. So nothing will be reduced. So this is how you will come to an amount which is called as your adjusted basis of new property which is received. Okay. It will be 2,50,000 minus 80. So it will be 170, I think. Right? 40 is getting offset. Here 2,50,000 minus 80. So yeah, 170 it will be. Okay. So 170 will be the amount at which Adam will recognize the value of new property which he is receiving, the FMV of which is 2,50,000. Now calculate it from the point of view of Charlie. See, from the point of view of Charlie, whatever property you are receiving, take the FMV. See, what is the FMV of the property that Charlie is receiving? 2,20,000. Whatever mortgage Charlie is giving up, we will add it. That is 1,50,000, we will add it. We will reduce if any cash is paid, right? Cash is paid by Charlie. Yes, it is 10,000. So we have reduced the cash. So that is the total. Minus whatever is given up. Charlie is giving up the property which is having adjusted basis of 1,75,000. So we will reduce that adjusted basis. We will reduce the mortgage which Charlie is assuming from Adam. That is 80,000. We'll reduce that 80,000. Reduce the cash paid. Charlie is also going to pay the cash, right? So Charlie has paid the cash, so we'll reduce that cash. So this is our realized gain. Out of this, how much we are going to recognize? Let's see what is the bought amount. Charlie has received cash? No. So cash is 0. What is the net liability? See, Charlie's liability is higher as compared to the Adam. So net liability is higher by 70,000. So I can say 70,000 is the bought amount for Charlie, right? And then whatever is cash paid was 40,000 and exchange expense paid was 10,000. So we will reduce this both amount and then we'll receive a bought amount that is 20,000. So how much I'll recognize, 20,000 or 65, whichever is lower, that is 20,000. Now again, let's calculate the property value for Charlie. For Charlie, how we will do? Same way, take the adjusted basis of the property given up, that is 1,75,000, right? Sorry guys. Okay, take 1,75,000, and then what you will do, whatever mortgage you are receiving, you will add it. Whatever mortgage you are assuming, that is 80,000, this is assumed by Charlie. Whatever mortgage you are giving up, you will reduce it, that is 1,50,000 you will reduce. Okay, then whatever is the bought amount, you will reduce it. Step 2, right? Step 2 you will reduce. What is your step 2? It's 20,000. So I'll reduce 20,000. Whatever gain you have recognized, you will add it. Step 3, I can say. Step 3 is nothing but my 20,000. Okay, so I'll add the mortgage, 20,000. Then one more thing you are going to add, that is cash which Charlie is paying. Charlie is paying cash of 40,000. So I will add this 40,000. Got it, guys? Exchange expense has already been included in the bought amount, so I'm not going to count it differently. So let's calculate whatever is the amount. Whatever is the amount, this will be the adjusted basis for Charlie. Okay, that's it. This was an important topic. In case of like kind exchange, there will be 2 or 3 sums from this topic, guys. So please go through it. And since this is a calculation sum, it will be of 2 marks. So from this topic, like, you can have a cash marks of 6 marks as a cash marks. Just remember to draw these charts. Remember to draw the this stepwise sequence, so that you will able to get the answer actually what the question is asking. Question may ask a realized gain, maybe ask recognized gain, may ask the bought amount, may ask the basis of the property. So just draw the whole stepwise manner chart and then answer the question, whatever the question is asking. Okay, so here I have just included in theoretical manner. You can just revise it from here, but it's better to go through the example, the first and the second example. It's enough, guys, for this topic. This example is enough. It includes each and every scenarios in over here. Next, the last topic of this chapter is related party. Okay, if the taxpayer and the person who is taking the property, they both are related, right? The taxpayer and the related party enters into a like kind exchange, and either of the parties disposing of the property within 2 years, then both the party must report unrecognized gain or loss on the return. See, this is in case of like kind exchange, it is not recognized, only the bought amount is recognized. Have you seen that? But if any of the party is disposing of the property within 2 years, then whatever was unrecognized means what? See, here we have a total gain of 5,500, right? Out of this, we have just recognized 500. So the 5,000 which was not recognized by A will recognize 5,000 if either of the person is disposing of the property, if this is a related party transaction. Got it? Both the party must report unrecognized gain or the loss on the return. Loss is not deductible if transaction involves family member, partnership or S corp who is having more than 50% direct or indirect owned by the taxpayer, tax exempt charitable educational organization which is controlled by the family members. So these are can be called as in the fall in the definition of a related party. So in that case, loss will not be deductible. But how they can get the benefit of loss? For example, A and B are related party. Okay, and whatever sales is happening between this 2 person, right? For example, selling price minus B has paid some amount. So here there is a loss. So A will not reduce the loss when B will sell to the unrelated party this property, right? There might be a gain. How the gain will be there? Whatever cost is paid, whatever selling price is there, right, which is sold, minus whatever cost is paid, this amount will be the gain. So B will not recognize the whole gain, but first he will take the benefit of disallowed loss which was previously not allowed to A. Got it, guys? I'm repeating, there will be one question from this topic and it will be 2 marks. So see, almost I can say 10 marks question will be there from the basis of property. Property chapter is very important. Corporation chapter is important. Partnership chapter is important. This three covers your, I can say, 80% of syllabus. Okay. So whenever there is a transaction between the related party, the loss will not be recognized at that time, but whatever is disallowed at that time will be reduced from the gain which the related party is going to sell the property to unrelated party. Okay. So this was, I guess, our last topic. Yes. I want you guys to solve at least 50 to 60 questions from this topic. Then only you'll be able to apply your mind in this, because there will be a lot of calculation which needs to be done in this type of sum. To reduce your time in exam, please use this chart, this stepwise manner which we did right now in case of exchange. Please use this. So yeah, tomorrow we are going to start with the other new topic. So that's it for the day. Have a great day. Revise the topic and do solve a lot of MCQs. Thank you guys.